Something so unusual just occurred and we need to talk about it. 8 up weeks in a row, and the S&P 500 registering its best win streak since 2017. And with cool PCE data coming in today, it's hard to see anybody bearish. But as Christmas approaches and volumes fall off a cliff, will bears be able to make their stand next week? Well, we have the stats. We're going to go through them together, but we also have to discuss the big banks. The short-term bank funding program created after the SVB banking crisis is now being used for the opposite of what it is supposed to prevent. And last time we saw this type of arbitrage spread was in 2007. So as we wrap up a volatile but bullish week, let's talk about stocks and the financial markets and what we can expect in 2024. Hello ladies and gentlemen, welcome to the Daily Recap Show. My name is Chase. We do these videos every single day talking about stocks and the financial markets. If you like this video, subscribe, hit the like button, hit that notification bell as well. Let's get into it. Another day, another dollar, except for Nike shareholders down nearly 12% on the day, as well as mega caps, Apple, Nvidia, Meta. They really underperformed, but cyclicals, consumer cyclicals and discretionary as a whole after the Nike news were the real underperformers today. And looking at the majors, Russell 2000 small caps, great day, as well as S&P 500 and Nasdaq, nothing to scoff at again. We did see quite the volatile trading session, so a massive dip, and then by the dip, bulls came back into the market. And this, guys, was all zero DTEs, and I'm going to show you why. During the day, we saw a bunch of negative gamma come into the tape intraday at the 4700 strike. All of this were sold puts, and the IV curve was blown absolutely to the downside, and then zero DTE dip buyers came in and bought it. And that's exactly why we had that massive sell-off and then rally mid-session. That being said, it was a positive day overall, as well as a positive week, and that's 8 up weeks in a row. Absolutely crazy. And here are the stats. After we've had 8 up weeks in a row in the S&P 500, 1 week later, we can expect about a 0.5% return, but it gets really, really good. 12 months later, we can expect about a 12% return. 17 wins, 3 losses. 8 up weeks in a row is actually very, very bullish. Now, looking at the best sectors, and again, we continue to see this broadening out and switching up of who are the leaders in the day. Yesterday, we saw software as the real leaders, as well as semiconductors. Today, it was back to metals, staples, GDX, regional banks. Discretionary, again, on the Nike news, put up a pretty average day. But all in all, the broadening out continues, and I do think it's going to continue into 2024. Now, concentration is actually very normal in very strong here. Have a look at some of this data, fantastic data I got right here. So in years when we've had very, very strong years, 2023 we're up 25%. Now look at 2021, up 28.5%. Percentage of winning sectors, 36%. Look at it in 23, 27%. Look at another strong year, 2013, 32.2%. Percentage of winning sectors, 36%. And also I got some more data here from the Nasdaq. When the Nasdaq has had a 10 to 25% return on average, the stocks accounting for 50% of the returns in the index is normally between 2 to 4. 2023, 4 stocks. 2010, the same thing here, 2007, 2004, 1997. So concentration is just a feature, not a bug of bull markets. PCE data dropped today. It was very cool, a lot cooler than expected. Here are the numbers. I'm not going to read them out, but what you really want to look at is core year over year, 3.2% year over year versus 3.3%. Consensus, it was 3.5% in October. And looking at PCE annualized over a 6-month period, we're actually at 1.9% within the Fed's target range. And that means if we use the exact same PCE metrics over the next 6 months, we will have a year over year reading of 2% by April 2024. And to think the Fed thought we were going to reach 2% by 2026. Now anything can happen. Inflation can resurface itself, but as it stands right now on a 6-month annualized basis, we're at the Fed's target. And I think the Fed needs to start cutting rates. Now on top of this, guys, we had durable goods orders and it was very good. 5.4% increase month over month. 2.2% is what they thought it was going to be. And excluding transport, plus 0.5%, 0.1% estimated. And I also posted a bunch of stuff before the open yesterday on the economy and why I think it's thriving. Have a look at TSA checkpoints. The most TSA checkpoints we've ever had in 2003. And we're not even in the busiest Christmas holiday season yet. After Christmas towards the new year, that's a super busy time for travel. Looking at real good spending, still well above the pre-pandemic trend and moving higher as per usual. Looking at US rail traffic, and this continues to support a thriving economy in Q1, Q2, 2024. And on top of that, American employers are offering record starting wages, just under $80,000 for starting a new job. Very, very good. And we've finally broken out from this kind of consolidation range we've had here, not to do any technical analysis. And wage inflation is also at 5%. Now, the Fed does want it in this range right here. We are above the Fed's target. But if we look at this as a whole, sure, it might contribute to inflation, but America's wages are beating the rate of inflation. Now, all of these things combined is the reason why people are bullish. And the AAI sentiment survey has 52.9% of participants very bullish, with only 20.9% very bearish. And we are at the 1-year bullish high. So everybody's bulled up, and this is what you want to see in bull markets. Huge participation from everybody. There are risks ahead that we do need to consider. Liquid assets to liabilities. I showed you guys this yesterday, and although liquid assets against liabilities is coming down, it's still quite elevated. Credit card delinquencies are rising, and they're expected to keep rising. According to Goldman Sachs, we should see an increase in credit card delinquencies in 2024 before we level out in 2025. On top of this, student loan payments are going to really start to feel the effects in 2024. The resumption of student loan payments imposes a 7% hit to income for the average household in the bottom income quartile, and has likely caused some major missed credit card payments. And this is probably why Goldman Sachs predict credit card delinquencies to increase, because student loan payments are starting to take effect, and it's going to have a tangible effect, 7% to income, especially for the bottom quartile. But if you actually have a look at this data, it's really affecting everybody quite significantly. But according to the market, a lot of this is priced in. GDP Fed now has 2.5% GDP, and the market has really priced this in, because if you actually look at it where we were 2 years ago to today, the market is relatively flat, and we are expecting significant earnings increases next year. And this is why market participants are bullish, and this is why fund managers are now 97% exposed to equities, and this is strong participation. And strong market participation is not a reason to be bearish. Look at the data. When we have the NAM exposure index 90, this is the returns we can expect. Average returns 1 week later, 0.18%, right? Very poor hit rate. We go to 1 year out, anywhere from 11.48 to 14% return, 76% hit rate. This, guys, is very positive. And this actually coincides with election year seasonality. So election years are very bullish. It's actually the second most bullish year of the presidential cycle. What we do need to consider is that during the election year, the first 3 to 4 months are very, very flat, and then we get the rally afterwards. So we are going to be looking for a substantial dip anywhere in March, April, May, this period right here. That's when we're going to look for our dip. And if you want to be in the know, go ahead, subscribe on YouTube, follow me on Twitter, and you'll be in the know. Looking at some more seasonal data, this is the Grinch parameter, the 3 days before Christmas and the 3 days after Christmas. And this is what we've returned so far. And long story short, normally when we have a negative Grinch, it coincides with a positive January and a positive calendar year. Now, a positive Grinch doesn't mean a negative calendar year, but when we have seen double-digit down years in the S&P 500, it has coincided with a positive Grinch, except 1969. And this is what we've done so far. We are all in all negative so far for the first 3 days, but that could change substantially because the day after Christmas is normally very positive. We could see here in the Dow Jones, S&P 500, Nasdaq, and Russell 2000, we normally see very positive returns, upward of 0.3%, and quite the hit rate on the Nasdaq and the Russell. The Santa rally continues to show signs that it's going to be very, very positive, and the data supports that. Furthermore, if we look at the last 5 days of the year, plus the first 2 days of the new year, also known as the Santa Claus rally or the SCR period, we normally return anywhere from 1.32 to 1.66%, 79% hit rate. Extremely positive, and it might actually be the most positive trading period of the year. Now, here's some data from BOFA, just switching lanes, guys. Cash is the biggest winner of inflows this year. A lot of people have cash and are holding cash. Look what's in second place: government bonds, investment grade bonds, and then equities. This is absolutely crazy. And have a look right here. Earlier in the week, I showed you guys that in money market funds, there is 6.1 trillion US dollars just sitting. Now, this is US household deposits. There's $17.7 trillion of dry powder. Now, I do know that this is used for stuff like loan repayments, mortgages, houses, food, that sort of thing. But there's a lot of money just waiting on the sidelines, waiting to be invested in bonds, in equities. And if the rally continues, a lot of this money is going to start flowing into risk assets. So where should you put your cash? The S&P 500 PE is at 20, but if you go the S&P 500, excluding big tech, you actually have a 17.3 PE, quite reasonable. And if you actually look at the rest of the world, you can get stocks in the United Kingdom and some emerging markets for like 10, 11 PE. So there is still value to be had despite this rally here, guys. But definitely, you know, if you do want some of the best assets in the world, look at the US, or look at the US excluding big tech, or the equal weight. I do think the equal weight is going to outperform in 2024. And that way you get the big tech names, but it's equally weighted in the entire index. We got this headline yesterday, something very interesting. The BTFP, pretty much when we had the banking crisis in early March, the Fed created this facility for liquidity reasons. And big banks are using this in an arbitrage way to make a 53 basis point spread. Long story short, what they're doing is banks are putting treasuries as collateral in the BTFP, and the Fed is loaning them money at 4.88%. And then they're taking this, putting it in their Fed accounts, which pays them 5.2%, and they're copying a 53 point spread. Just some arbitrage getting played right there. And I think a lot of banks are going to jump on board this. We should see this number rise into January, February, and March. So financials could see outperformance in 2024 thanks to this, because it's pretty much free money and it's billions of dollars, guys. Now let's move on and talk about seasonality. I put this up on Twitter and I said weakness after VIX expiration was expected. Now we did see weakness in the middle of the week. End of year supportive flows return mid next week. It'll set up the Santa Claus rally. This is the gamma flip level. That's where I turn bearish. 4808 is my target, but expect choppiness until next week, Wednesday. And we are in the window of weakness. For those of you that don't know what it is, after OPEX, right here, we are in this window of weakness. Essentially, dealer supporter flows are not quite as strong in the market as they are in the first 3 weeks of the month. And this is where we can see quite a bit of volatility. They do return towards the end of the month, and that'll be around next week, Wednesday, next week, Thursday, potentially as early as next week, Tuesday, depending on how much gamma gets into the tape. But looking at gamma, yesterday we saw a ton of puts come into the tape, but that has since disappeared. A lot of them were just zero DTEs, as you can see, and we do have a lot of call gamma in here. Long story short, what happened? Zero DTE negative gamma took us lower, and then a ton of people bought the dip with call gamma, and this is why call gamma has rebuilt in this section. We're still at the 4800 strike as the call gamma resistance, and I do favor price action to 4808, and that has been my target since early October when I told you guys to go long at 4125. And here's the gamma heat map. Very, very interesting stuff. So we had a fairly muted day until we got to the top of the range. We got into this positive gamma zone. We know what happens in positive gamma. Dealers sell rips, then dealers sold us to this sort of like neutral gamma zone right here. And we pretty much sold all the way down at the top of this positive gamma zone right here, where we found support. Dealers took us higher, and pretty much we closed in this little negative gamma pocket right here. And this is how next week is going to play out. Strong resistance just above 4760, strong support at 4730. If we get above 4770, we get into this negative gamma zone, we could go as high to 4800. But I do think that 4730 will hold the line next week. I mean, just look at this gamma zone. Very, very big, but there is a lot of negative gamma below it. So just be careful that below 4720, things can really get serious for the sellers. Now let's have a look at some charts. And guys, let me know in the comment sections below what tickers you want to see and what charts you want me to cover. S&P 500, very, very bullish. This is a bullish chart. We got this like cup and handle breakout right here, and we've even broken above this trend line. Probably go higher to 4808 like I just talked about. Nasdaq 100, very, very similar situation, just looks much stronger. Is a tad overbought. This is the weekly chart as well, but again, you know, this cup and handle, we've broken out, and we're sort of like gonna break out above this level as well. If we could really go test some serious new levels in the Nasdaq. Looking at mid caps, the weekly chart, this huge resistance that we found here, here, and here, we've actually broken above and closed on the weekly above it. Very, very bullish. We want to now use this as support, look to higher price action. 3000 is the play. Looking at Russell 2000, very much the same thing. We had huge amounts of resistance right here, broken above it, closed above it. Now let's use it as support to look for higher price action. I did say that my price target was 212 in the Russell 2000. Looking at Nike, very, very brutal, actually below the 200 moving average. And I think we're just going to consolidate here. That's all Nike's got to do while the market assesses what's going to happen next for Nike. I am not a buyer right now. FedEx doing exactly what I said it would, and that's consolidating at the 200 moving average. Very similar situation to Nike. The market needs to assess what's going to happen next and where it's going to go in 2024. Micron, very bullish. Another 1.18% day today after a strong earnings yesterday. And it's probably going to go higher. I do see probably even as high as 100 in 2024. Don't fight the trend. Higher highs, higher lows. This is a very bullish chart. Looking at mining, very strong chart. At the start of last week, we said a breakout was pending. That's exactly what happened. And metals are broken out. And like I said, metals, energy, gold, it all looked like they were pricing in a recession and the market is re-rating them. I do think we probably go higher. We're probably going to go tease these highs right here and probably tease this high as well. Looking at regional banks, KRE, and we're finding very strong resistance right on the moving average. Regional banks really need to find support and push above. They need to do that, but it's a very weak sector. Any weakness in the market and regional banks just dump, but they have been extremely strong the last 4 to 5 weeks. So let's keep the strength up. Now looking at GDX, what GDX need to do is push up to this trend line first before we think of anything else. Comm services, in other words, Google, Apple, Netflix. This is a very linear chart, not much in terms of drawdown. It's going to continue to be very, very strong. I do think in 2024, Google, Meta, Netflix, I think they're going to outperform next year and the year after. Technology fund, very similar to the Nasdaq, but stronger. This cup and handle was forming. We've broken above it and it's in uncharted territory. Pretty much every time it goes higher, it makes a new high. What I'd really like to see is probably come back down here, test a support and go higher. That's going to be really constructive for further price action in 2024. But it is tech, very strong sector. If it just continues to rally, don't be surprised. ASX 200 for my Australian followers, not quite overbought. We can probably go higher, but we did reject at this trend line. This is the trend line from July 2022 when we made the highs, guys. And what the Australian market needs to do is push above here and use it as support. Otherwise, it's looking pretty grim for lower price action where we might go back to this moving average. Now, here's some data ahead, guys. Very, very light data next week. We got the Case-Shiller HPI, wholesale inventories, advanced good trade balance, jobless claims, pending home sales, and then whatever that data point is. Next week is going to be very light in data, in volume. You don't want to do much trading, guys. Merry Christmas to every single one of you as well. I hope you guys go have a fantastic Christmas. Spend some time with your family, get away from the charts, and go have fun. Thanks, guys.